Hi, welcome back to another video. Sorry, I've not been posting for the past 2 weeks. That is because I have not been trading. I've been staying away from the markets because of the choppy nature of the markets. Markets are gapping up, gapping down, and moving, making 200, 300 point moves every day. So it's very difficult for positional traders. So if you are a positional trader who is holding overnight positions, be very careful, hedge properly, and reduce your positions. As you can also see here, for the past 1 week I have not been trading. For the last week of March I have not been trading. I started initiating positions on the 25th of March, which is this candle here, and the expiry was on the 1st of April. Okay, let's see. I'll go over what all I have done. So my entry point is somewhere here. Okay, Nifty was here. This is my entry. This is my entry, and as you can see here, obviously the support here is 13,600, right? 13,600 was my support, and that is will be the put option I will sell. Okay, then I always hedge by buying 13,300 put. I buy. Okay, so now that I have sold this part, then I went in on top. The market has gone down so much, so it is possible that, as you can see here, the market came down and then went up. We came down, went up, came down, again went up and came down. So it is not able to break this high, it was not able to break this high, and it is not able to break this high. So my understanding was that the markets are a bit of in a bearish mode. So I was okay to sell 15,000 call, sell, and 15,300 buy. So if you can see here, markets, if it goes above 15,300, my loss is capped. So if the markets rally and just go to 15,500 again, my my loss is capped, so I don't have to worry too much. But my understanding was that the markets will not cross 15,000 because of the lower lows. Look at the 1, 2, 3, 4, 5 big candles that were formed, which means the downtrend was there were large volumes of shorters. So even if it may be a sell on rise market, so even if the markets go up, people will try to um, sell, and then the market might come down. So given this is what I initiated on the 25th of March. So on the 26th, you can see here the market made a doji kind of candle, which meant that the market was not sure where it was going. So it could possibly be that it might again come down, or it might be around this area. So on the 26th, this had decayed quite well. So okay, so what I did on the 26th, so on the 26th, the markets were here. So what I did was I bought 13,500 and I sold 13,800 because I felt like the market had moved up and it did not cross the day's low. So the low was somewhere here. So I sold 13,800. Then the markets had gone up. So I also additionally sold 15,100 and 15,400. So I had sold this spread. As you can see here, what I have done is instead of adding all my quantity on March 25th, I added half on March 25th and I add half on March 26th, because I realized that a lot of times, this is Thursday, this is Friday. A lot of times Friday there is a big move. So I was waiting for some big move to figure out what the direction was. I don't know if the market was going to go further down or up. So given that on Friday the markets were indecisive, I entered another leg, but now it is spread. So overall my risk is also spread. So if the market goes up, I have to only worry about 15,000. If the market goes down, I have to worry only about 13,800. 13,600 might still be in profit. Okay. On the 30th, if you can see, on Monday, the market gapped up. The market gapped up almost 100 points, 100 plus points, and then again it rallied about 200 points. So overall from here it is 300 points up, right? And from my entry, which is 14,300, it has moved up 500 points. But the best thing is, my calls and my calls that were entered on Thursday had already gone through 4 days of theta decay, so they were still quite close to being break even, but my puts were all in very good profit. Okay, so what I did was I was scared about 15 to 100, so I closed this at a loss, okay, a small loss, and I opened a new set of trades. So I closed these two at profit, at a very good profit. And then on the 30th, which is the Monday, what I did was I opened two more additional calls, which was 14,000 and 13,700. Sorry, puts. I did this, and I also did 14,200 and 13,900. So as you see, very simple. 1, 2, I've closed these two and I've rolled them up. I have rolled them up. I have rolled them up. Because why? The market is going up. Because the market was going up, I closed this at a loss and I moved it up to 15,200 and and 15,500. Very simple. Okay, because the market had moved up, the option premiums were very high. This is all I did. Then on the 31st, as you can see here, 31st, the market came down again. So my calls were again in profit. So what I did was I re-entered this 15,100 and 15,400. So I would overcome this loss, and also all of these would have still been in profit. Okay. So this is my plan. Very simple. I entered here. Let's say market goes up, roll PE. The market goes too high, close CE, and then roll CE. When the market comes down, this is also in profit, this is also in profit. This is all. But the biggest problem here is we can adjust for one such movement. If let's say that the biggest problem here is if the market gaps up and gaps down, right, continuously, then we might not be able to handle. So if you see here, the market closed, gaps up here, gaps down here. Up and down movement is very difficult to handle. Here, this is one-way movement. It just went up and then it started correcting back. So this is easy to handle. So after the 31st, I did not change anything on the 1st and I let it expire. All of these expire. I didn't even square them off. I let them all expire at 0. So I'll now show you what my PNL is and how that came about. So this is my PNL report for 1st of March to 1st of April. So I've already filtered only those options expiring on Nifty options expiring on the 1st. So first entry was this. Okay. So this is my put side and my call side is this. Okay. So this is my first entry. Now you can see here my puts, because the market went up, was in a profit of about 7,000. But my calls were in a loss of 4,800. Overall, I was still in a profit of 2,000 even though the market went up. So as soon as the market went up, the next day I sold 15,500, 15,800 and 15,100, 15,400 the next day. So because the market had moved up. Okay, so this is my next entry. So after the market, next day it gapped up, if you remember. Then I had sold 13,700, 14,000 and this and this. Okay, this 14,300 was I had closed 14,200 and then initiated this. So this is my third round, and after that I had opened this one 15,200 and 15. As you can see here, second round of profits were not much. I was actually in a loss of minus 1,800. Why? Because I had closed this at a loss of 4,000. I had closed the call at a loss. It's better to get out of the call in case if you see like the market is going up. Then I re-entered and I made a profit of 5,000. At all of these times, my puts were all positive at 11,000. So overall, my realized profit for this expiry was 17,115. Okay, so 17,115, and yeah, so this was again a very good week, even though there was a big move up. But one directional moves are a bit more easy to manage. If it moves up and then had gap down, then it would have been a difficult adjustment. But this week it was easy. um, I will next video. I'm thinking about coming up with what are the issues that I have faced with selling iron condors. As you can see, iron condors are fairly easy in terms of adjustments. Also, roll up, or roll down. Okay, so this is very simple, but there is one big concern. Actually, two big concerns: overnight gap ups and gamma risk. So I'll probably come up with a video of what gamma risk is and how we can try to avoid that. Okay. Okay, guys, I think for now, that's all. I'll catch you guys in the next video. Bye.